Good afternoon, everyone, and welcome to the second edition of the webinar Refugee Finance in Times of Uncertainty, Identifying Opportunities and Mitigating Risks. We have held one webinar already, and this is the second one. And we also would like to thank this time again our sponsors, Triple Jump and Microfinance Center, for sponsoring this event and making this possible. But also I'd like to thank everyone here involved in the preparation and all of you in the audience to discuss with us this important topic today. Let me go on with introducing our speakers. Actually, we have 8 people today with us contributing, and I go ahead with introducing to you the panelists first, by the order of their speaking. So I start with Dumitru Vicul, who is a financial market and strategy expert focused on emerging economies. Welcome to the session to all of you. And our second speaker is Dimitro Romanov, who is a banking expert and business analyst at Business and Finance Consulting. We have then again in the session, Malchas Dzadzua, who is a financial inclusion and strategy expert and the former CEO of a leading MFI in Georgia, Crystal, where he was the CEO between 2004 and 2019. And last but not least, we have Miss Violette Cubier in our panel. She is from the foundation Grameen Crédit Agricole in France, and the program manager for technical assistance. Thank you very much to all of you for making the time today to contribute and to prepare. But we also have special guests which will contribute to this session today, and I'm happy to introduce Mr. Michael Newson, who is a senior labor mobility and social inclusion specialist at the IOM, International Office for Migration. And we have Mr. David Russia, Analytical Director at the Banking Association of Georgia. We have also Ms. Laura David, Head of Business Development at BCR Social Finance in Romania. And we have Nixon Kwarigyuka Kaheru. He's a Business Research and Development Manager at Ugafold. It's a microfinance organization in Uganda. And Nixon, thank you. Special thanks for you because you jump in on a short notice for your boss, Shafi Nambobi, who had to go to another appointment. Thanks to all of you for being with us. And let me set the stage by just informing you about the topics we will discuss today. We have last time discussed already about the impact of the war in Ukraine on neighboring countries, on refugees, refugee finance in neighboring countries. And today we again look at a couple of macro issues. We have prepared quite some analytics for you that appear and unfold as a result of the war in neighboring countries, such as remittances due to the economic decline. There are quite some remittances flows in the region that go from some countries to the other countries, and they are getting affected now. We have a point to discuss the impact of the war on financial service providers and their balance sheets, their portfolios. But of course, we also want to hear what could be solutions to these issues, to these problems for financial service providers, to get on with their business, to keep servicing clients, and in particular, keep servicing refugees, and also touch upon potential fintech solutions for FSFPs. Now, with no further delay, I would like to introduce our first speaker, Dumitru Vicul, who will set the stage by outlining some key issues that are driven by the war, including the cost of capital and also about inflation. Dumitru, the floor is yours.
Thank you very much for inviting myself. I'll try to touch on a few points like rising cost of capital, the deglobalization more from the macro perspective, which I think that maybe is the main driver of anything that we see at the moment. So, I mean, we have been used to see long-term sovereign bond yields very, very low for a while, but it has continued to rise in the past, maybe, let's say, 12 to 18 months. And that was a combination between, unwinding of the asset purchase program from the central banks. And of course, we got a little bit more inflationary expectation that is feeding through everything. So you can see that everything is getting like more expensive and so on. So the chart is actually showing you how many bond yields had been negative in the past since 2014. So suddenly you can see that maybe in 2021 that the share, the amount of the bond with negative yield has significantly reduced. And this is kind of giving you a signal that we are back to an environment where the cost of funding, at least from the government's perspective, is getting more expensive. In the next slide, I will try to point out that even in addition to the rising cost of capital from the global perspective, from the government side, I would say, of course, we also got some increasing country risk premium that was driven by the recent development in Russia and Ukraine. So you see the chart that is showing the CDS, the credit default swaps for most of the countries in the regions in Central Eastern Europe, I would say, and you see like how the credit default swaps for Serbia or for Romania has increased, mostly because investors getting a little bit more worried about those countries regarding the supply chain disruption and energy disruption, any potential implications of the military action and so on. So in addition to the rising cost of capital in the global market, we also got an increase in country risk premium. And all those two things is giving you an environment where most of the investors will try to ask for higher yield for any type of investment, and that is definitely kind of going to affect the SMEs and so on. In addition to rising cost of country risk premium, you also got some disruption the commodity side. So in the next slide, we are trying to make the point. In the next slide with commodities, we're trying to make the point is that the prices of the agriculture products had increased significantly. You know that Russia, Ukraine accounts for maybe 30% of the wheat, 20% of the corn, mineral fertilizer, and things like that. But another point that is very interesting is that we are moving probably into different trading blocks. And now I would say, automotive companies like in the Czech Republic or Hungary, they can source the iron ore, they can source aluminum, for example, but from a different countries, let's say from Brazil or Australia, but they are paying higher price in order to, they're paying a premium in order to get these, to make those raw materials available. So the point is like, even if we are moving back, let's say, even if the war finished tomorrow, things like that, suddenly, even that we think maybe the expectations of the raw materials would go back, would go to pre-war level, would be quite optimistic, because we are in a new reality where the trading blocks is making you in an environment where you would have to pay a higher price for the most of raw materials in order to make it available, unless you are part of, you can source those, some particular raw materials, in particular in the trading block around the Russian satellites or around the US or Western world satellites. So these frictions, I would say, is going to stay with us for longer, I would say. So we have rising cost of capital from the global perspective, from the government side. We have an increasing country risk premium for the countries in the Central Eastern Europe and Central Asia as well. On the other hand, we have rising more raw materials. And that this is meaning that all of the companies that would like, to develop, to invest, or to expand their operation, they're going to be facing these issues. So in the next slide, I will try to, I'm trying to point out which countries maybe is the most vulnerable. So of course, that some particular countries, they kind of significantly reliable on the Russian gas. Other one, they like, let's say like Latvia, Czech Republic, or even Moldova, Hungary. Other one, they're importing a lot from Russia to the countries like Kyrgyzstan, Tajikistan, and Kazakhstan, or the one that had high net imports from Ukraine, which is Republic Moldova and Georgia and other countries. So I would put in the region from the Central Europe, southern part of Europe, and up to the Central Asia. Probably I would say that Latvia, Czechia, Moldova, Hungary, Bulgaria, and Serbia are probably the most vulnerable to any commodity supply chain disruptions. And if this is happening, then you got the government that is trying to deliver a lot of fiscal measures, the fiscal support. So they are trying, to cap some prices. They're trying to reduce the VAT, or then they're trying to, to increase the wages and things like that. But imagine the biggest issue here is like, most of the government were expecting to have a solid recovery in 2022. To replenish the fiscal reserve, to go back to the fiscal consolidation. But now suddenly everything has changed, and those countries, they have to spend a lot of money, to support their household. So even bigger issue is the fact that if you believe that the European Eurozone or the world is moving to recession phase, let's say next year, for example, then the government would have even less room in order to support the household. So this is making the things even more difficult in the upcoming year or two. And the other important thing is, like, in addition to this commodity supply disruption, we also have a deglobalization. So in the next slide, you're going to see that a lot of multinational companies, they have already announced some deep investments. And this is kind of affecting even the SMEs that were producing a particular component for a particular company that was exporting, for example, the Russian market. And the divestment of the multinational companies, it could somehow affect the SMEs as well. On the other hand, you see, like, you have this deglobalization out of related to Russia. On the other hand, you have deglobalization related to China, the nearshoring, that more and more companies, maybe the German, Austrian company, they want to transfer their facilities to, in the Czech Republic or Hungary or Macedonia, for example. But which is probably a good thing for some particular countries that they might benefit from this transfer. But we have to understand that, that deglobalization means higher prices. So if this is true, then it's meaning that the interest rate or the government bond yield or the cost of funding should be high as well, in order to, because they embedding the inflation expectation into yield. So it's just, to summarize what we are trying to, what would be the main message is that we are in an environment where the cost of funding maybe will stay high for longer, and the inflation probably will going to stay a little bit longer for us than expected, probably definitely longer than we were expecting 3-4 months ago. And this, in addition to the country risk premium, elevated country risk premium, and deglobalization, is making the environment for SMEs a little bit more difficult. But of course, like you have, of course, every crisis coming with some sort of opportunities. So this would be the nearshoring. So any transfer of facilities that would need to be transferred from the other part of the world in order to be closer to the main consumer demand, consumer market, like in the western part of Europe, then should be kind of supportive. So I think this will be the main messages that I have from the macro perspective. So I think if at the end we're going to have so many questions, I'll be happy to answer.
Thank you very much, Dumitru. This was a very good stage setter and providing us with insights what is driving these factors that lead to more fragility and less stability, all the shortages you mentioned. And I think we can say it's just unfolding. It's still very dynamic. So it is hard to guess where things will move, but it will definitely be a challenging time ahead with shortages on all ends. And that brings us to the next topic. We, after your macro overview, want to talk about remittances and the impact of the war on remittances. And this will be done by Dumitru Romanov. But before he's starting, we would like to shortly participate in a poll. What has been the greatest impact of the war in Ukraine on your financial institution? So is it refugee demand for basic financial services? Is it reduced remittances? Is it sanction impacting their client solvency? 41% say refugee demand for basic financial services. We have to see here what this means in detail, but I guess we will have time to discuss this. Reduced remittances, yes, and sanctions. So it's a bit of everything, and probably there are also more. Thanks a lot for participating, and that shall be the stage setter for you, Dumitru, to enlighten us a bit about the current situation with remittances flows in the region affected by the war. Dumitru, the floor is yours.
Thank you for the kind introduction, Michael. Leading up the war, high oil prices and strong economic activity pushed a relatively large inflow of migrant workers into the Russian Federation from countries with lower average incomes. The majority of these workers are un- and low-skilled laborers. For example, nearly 70% were involved in construction activities in 2019. It's interesting that many Ukrainian nationals made this move permanently and tend to have been living there for a longer period of time than workers from other countries. This is evidenced by a relatively low remittance level from the Russian Federation to Ukraine as compared to what we see with other countries, as we will see on the next slide. So despite overall numbers of migrant workers to the Russian Federation, the real impact of reduced remittances to source countries varies greatly by country. In general, most countries in Central Asia and the Caucasus are highly dependent on remittances from the Russian Federation. For example, remittances inflows from Russia made up 83% of total remittances in the Kyrgyz Republic for the first 3 quarters 2021. And this figure was over 50% for Azerbaijan, Armenia, Tajikistan, and Uzbekistan. This is especially notable as remittances sent to these countries tend to be a lifeline to those receiving them. For instance, remittances make up 31 and 27% of GDP in the Kyrgyz Republic and Tajikistan, respectively. These figures are comparable and in some instances larger than each country's export goods and services, nearly 100% in the Kyrgyz Republic and 155 in Tajikistan and 35 in Armenia. So I think it's beneficial at this point to examine the issue of remittance from the perspective of another very similar historical event. In 2014, the Russian Federation annexed Crimea and the western regions from Ukraine. I should mention at this point that Russia's economy during that event was impacted by both sanctions and low oil prices. So if we look at the impact of this event on remittances at both 1 year out and 2 years out, we can see that some countries like Kyrgyz Republic, Uzbekistan, Ukraine were able to soften the impact of remittance decline, which was quite sizable in the first year. It is worth noting that Uzbekistan also increased its GDP by 18%, meaning that remittances did not play an important role in their economy. Azerbaijan was affected not by a decline in remittances due to the insignificance, just below 3% of their GDP, but rather a drop of global oil prices. Since that time, the country's economy has been shrinking. And Tajikistan and Armenia showed the worst performance because in the second year, the remittances dropped even more than in the first one. And it should be noted that Georgia was not included here, as the share of Russian remittances to GDP was near 2%. Although remittances did drop by a quarter in 2014, the overall GDP was more impacted by the country's strong economic connections with Russia at the time and the devaluation of their national currency. The projections. Although the estimates that the World Bank did refer only to 2022 and considering that the impact will have a slow effect, a significant decline could be transferred to the next year as well. So this drop could be referred to as a crisis, as a single event. There is expected to be a twofold impact on remittances flows to Central Asia. The weakening of economic activity in Russia will likely dampen employment opportunities for migrant workers, thereby also impacted their ability to send remittances. And weakening of the Russian ruble against the US dollar will likely reduce the nominal US dollar value of remittances sent in rubles. In the first 2 weeks of the war, the ruble depreciated by more than 25%, but after its regulation by the central bank, it bounced back, and currently selling foreign currency is very limited. So the real market price of the ruble has dropped, but it's not clear now. It's highly regulated. Although seemingly stable at the moment, this stability is uncertain and may predict the ruble to decline against the dollar in the next 1 or 2 years. Moreover, the ruble and oil prices, unlike in the past, seem to have decoupled, meaning that oil price increase are not likely to save the ruble's devaluation. In summary, remittance inflows to many Central Asian countries are likely to be affected adversely by the ongoing war. Overall, the projected decline rate of remittances in this region is going to be around 25%. So overall, we find that remittance dependency as a percentage of GDP defines the impact of reduced amounts. Some countries have shown a resilience in the past, showing better performance in the second year. 40% decline in remittances from Russia is not the worst case scenario. And projections are very difficult in the current context, as they are dependent on the scale of the ongoing war, as well as the effectiveness of sanctions on outbound payments from the Russian Federation. Now, I would like to address a couple of questions to our special guest, Mr. Michael Newsom, who represents the International Organization for Migration. Michael, are you with us?
I am here, yes, thank you.
Hi. What do you see governments in Central Asia currently doing or considering doing to address the double impact of reduced remittances and increased return in migrant workers?
Thanks for the questions, Mitro. As I think you noted in your presentation as well, this isn't the first time the Central Asian region has seen this type of effect with the 2014 economic crisis, where we saw sharp drops in remittances, as well as large numbers of returns. You didn't give the return numbers, but there were significant returns within that period, particularly because the Russian Federation was really clamping down on irregular migration and irregular employment of Central Asian migrants in Russia at that time. This situation is somewhat different. The governments we speak to in Central Asia are obviously conscious of the likely negative impacts on their economies generally as a result of the Russian sanctions and slowdowns in the economy. And they're looking to implement sort of emergency economic relief packages in different forms that have been put forward by the various governments of Central Asia. However, they haven't looked yet at providing specific support programs for returnees or for remittance recipients seeing declines in remittances. And this is for a few reasons. The initial surveys that we've done of migrants and households indicate that some have struggled in the initial months, with about 20% having said that they've reduced the amount of remittances they sent, and 30% saying that they had stopped sending remittances. An additional 50% had said that the value of their remittances declined due to a decline in the value of the ruble. This has obviously changed since we did this survey. This survey was from, I think, around early April, and obviously things have changed somewhat now. But this is where IOM is looking to support governments in the region, because there's a lack of data in terms of where migrants are, where they're returning to, which communities are particularly impacted by remittances. So we're looking to generate sort of more detailed and up-to-date data on locations of return, locations of communities most dependent on remittances, so that in addition to these sort of general support, economic support packages put forward, governments can also implement more focused programs for migrant returnees and people dependent on remittances. And then more generally, something that governments in the region are doing is looking, and this is something they were trying to do even prior to the crisis, is diversifying the countries of destination for their citizens. So lots of agreements have sprouted up with countries in the Gulf, for example, South Korea, Japan, more recently with the UK, really trying to reduce dependence on migration to the Russian Federation.
Interesting. And how have the war and the sanctions impacted labor migration to the Russian Federation in recent months?
In this case, I think the data is still quite limited and anecdotal, but we do have some information based on surveys of intentions as well. What we've seen is that the majority of migrant workers in the Russian Federation are opting to remain, even when they've lost their job or received reduced wages, simply because they still consider their earning prospects in the Russian Federation to be better than their country of origin. What we've seen is that about 60% plan to stay. Only 35% of Central Asian migrants that we surveyed plan to return, with the majority of those actually planning to seek other employment in other countries once they returned. So administrative data seems to indicate similarly, we are not seeing a massive sudden flow of returnees. What we expect is that movements from migrants leaving the Russian Federation will be sort of more slow and steady if economic and employment opportunities start to dry up. What we've seen, though, in surveys within Central Asia is that the flows that you would typically see going from Central Asia to Russian Federation have slowed down. So people who would go seasonally, or people who are entering the labor market for the first time and would usually move to the Russian Federation, are opting to remain in Central Asia or to take advantage of regular recruitment programs because they want that security of having a contract and an agreement in place before going to the Russian Federation, whereas previously they would have gone and relied on their social networks to find jobs. So those are some of the key things that we're seeing in the changes in patterns of migration from Central Asia to the Russian Federation.
Thank you, Michael. That's some really great insight into this evolving situation.
Thank you, Dimitro, and thank you, Michael. I have one question to you that is a little bit outside the frame of what you discussed, but it is also a connection to it. So we all know that there has been migration in the other direction as well. So from Russia left about a couple of 10,000 professionals, maybe in the IT sector and others, to those countries we're discussing, Armenia and Central Asia and so on. Just keep working from there. And the question I have is basically, I mean, are we seeing already some impacts of that? Because that means also they are moving with their income to these countries. For example, I had last week a talk with someone living in Armenia, and he told me that in the last 2 months, rent in Yerevan, the pay for rent accommodation has doubled, and the real estate prices itself have gone up by 20%. And he was basically linking that with the inflow of migrants from Russia to Armenia. So you might not be prepared for that question, but I just wonder if there's any link between the two things we are discussing right now. We can see them, or we can maybe expect to be this impacting the situation in those countries as well.
Thanks. That's a great question. I guess I'll answer that. But unfortunately, we don't have any concrete numbers beyond what you're mentioning as well. But yes, we hear anecdotal evidence that large numbers of Russians have emigrated to Central Asia, particularly Kazakhstan, and to Armenia and Georgia. I think in Armenia and Georgia, it was most pronounced simply because they're smaller countries with smaller populations, so it had a greater impact, particularly on the cities of Tbilisi and Yerevan, where indeed we've heard the similar stories of rents doubling, of property prices increasing rapidly, and in some cases people being kicked out of their accommodation to make way for higher paying rents from Russians. So this is something we're keeping an eye on. Governments that we've spoken to tend to be of two minds about this. They obviously see the opportunities of having high-skilled persons coming in with possibilities for investment. And some countries have started to sort of put down the red carpet for this type of migration. Uzbekistan has been looking at particularly providing support for ICT specialists. Nazarbayev University in Kazakhstan has put in place a program for Russian academics to come. And a lot of them are also looking at their own well-educated migrants and diaspora in the Russian Federation who might want to return home, and seeing this as an opportunity for that as well. So we're seeing, yes, some challenges, as you said, in terms of impacts on prices, impacts on resources, but also governments looking at what the opportunities are to try to get people to stay, with the expectation, though, that many will move onwards, say, to European countries or elsewhere. And we already are seeing that sort of secondary movement, particularly from Central Asia to other countries.
Yeah, thank you very much, Michael. I think it shows that we have a lot of dynamics right now going on that make it a bit difficult to predict things, but it's second, third order effects we all will see, and countries have to deal with. So thanks for those very good insights and making the time to contribute today. And Dimitro, thanks for your presentation. We have time now to move on. I have another poll for our audience. We would like to know from you to what extent the war in Ukraine impacted, or you expect the impact on your loan portfolio growth of your institution, of your financial service provider. So very straightforward: greatly impacted, significantly, moderately, slightly, or not impacted at all. And here we have the results. That's exactly what I had in mind. Moderately impacted, 43%. That's the largest fraction. So it's something unfolding that probably will change over time. But we see significantly impacted, greatly impacted already, some serious impact also visible. So just the right moment to have this meeting today and to discuss about the problems and the solutions. And with that, we can go on to the next speaker. And I welcome Malchas Zadzua. As I introduced him already, a practitioner with deep experience, not only in his home country, Georgia, but throughout the whole region, and being a manager, a CEO of a microfinance institution, and in touch with many industry actors. Malchas, what can you tell us about your view on how FSPs in the region are affected and how they are coping with the challenges they face?
Thank you very much, Michael. It's great to be back with you for the second session. Today, I want to touch on three main topics from the perspectives of the financial service providers. First of all, this is about the increased risk for FSPs in Eastern Europe and Central Asian countries. Then we will see what we have learned from COVID-19 crisis management experience. And finally, we will discuss about loan portfolio growth issues as well as mitigation measures. So let's start with the risks that FSPs are currently facing in the region. We identified three main risk areas, and they are the high inflation, the credit risks, and cost of funds. So in terms of inflation, we already see that annual global inflation rate has more than doubled as of March 2022, rising from 3.7 to 9.2%. In many developing countries, inflation is reflected even in double digits, and we see this evidenced all around us. For example, food prices now are 9 or 10% higher compared to last year. And moreover, wheat and oil prices have increased by more than 50%. So although inflation impacts almost everyone, we know that it has a negative impact, especially on the living standards of lower income groups. And overly slowdown in economic growth, rising unemployment, and high inflation increase the risks of stagnation for the nearest future. So in terms of credit risks, loan portfolio quality is expected to deteriorate from 5 to 20% on average, also with increased probability of default. This is especially true for clients with the high dependencies on Belarus, Russia, and Ukraine markets. These factors, along with the reduced remittances on which Dimitro has just spoke, can result in overall deterioration of solvency and general repayment capacity of the borrower. So it should be also noted that in such periods, we usually expect an increase in fraud attempts. So the financial costs are also expected to increase significantly, and we already see this trend in the market, especially for local currency funding. So moreover, many lenders may restrict their new debt and equity funding due to the high degree of uncertainty, especially including regional and country risks. Another issue is that while funding sources may be still available in the financial market, the overall financial cost for FSPs will be higher anyway, because existing liabilities will be refinanced by more expensive new sources. So next slide, we can see how financial service providers can use their recently gained COVID-19 crisis management experience. So indeed, there are some things that we can take from this experience. In particular, both crises were unexpected and resulted in complete uncertainty, especially in the beginning. Both of them have their specific cycles, meaning that responses also need to take these cycles into account. So we have 5 or 6 waves during the COVID, and we also have now the 5 or 6 packages of sanctions, which requires different responses from financial service providers. Both crises also resulted in significant restrictions on global logistics, shipping, free movement, and trade operations. And we also saw a growing importance of modern technologies, digitization, and offering more and more online services to customers. So, but at the same time, it is important to keep in mind that these two contexts are also very different from each other. First of all, during COVID-19, we had a massive physical restrictions everywhere, and most people have been forced to work from home, which is not the case now in the Ukraine crisis. And also compared to COVID-19, the war in Ukraine and the refugee crisis has directly impacted only a relative few countries so far, so neighboring countries. It should be also noted that the post-COVID period became more or less predictable over time, while much uncertainty still remains about what the post-war period will look like after some time. So leaning into these similarities and keeping in mind the key differences, we find that risk management systems in many FSPs which have been constantly evolving and improving during the pandemic, are better positioned now to adequately respond to these new challenges. And thanks to the COVID-19 experience, FSPs now produce better quality of risk analysis. They prepare more practical and productive stress test scenarios, and they have more experienced risk staff overall. So it is also important that financial service providers now have a better understanding and the general consensus on the importance of risk-based decision inside of the organization and in all levels of their management and leadership size. So the next slide, let's see what are the loan portfolio growth issues and mitigated measures from the perspective of financial service providers. The overall impact of the war in Ukraine has been a general slowdown in loan portfolio growth. This is mainly due to a general business slowdown, which has reduced the demand for credit products in general. At the same time, we also see higher interest rates on loan products, and this is mainly due to increased financial costs, which we mentioned already, and credit risks caused mainly by deterioration in the solvency of lower income borrowers. This means that companies will face more competition for a limited number of low risk and creditworthy clients in the very nearest future. It should be also mentioned that there is still much uncertainty regarding the local currency fluctuations, which also limits further growth in loan portfolio. In response, there are some mitigated measures that can be put into place from financial service providers. So there are the list of some short-term mechanisms, which may include the regular stress test analysis and risk assessment by the companies. And we know that many FSPs who have very nice systems, they already produce the weekly stress test scenarios. Also intensive and direct communication with clients, especially those having export or import or business operations. Another mitigated measure can be limited lending to clients with a high dependence of Belarus, Russia, and Ukraine markets. And we know that most of the banks already take these measures. It is very important to keep the effective communication with key internal and external stakeholders, including regular updates on the institutional and the local market developments. In many cases, we see that the management of the financial institutions, they pay more attention for external communications. They have the very regular and intensive communication with lenders, investors, government, but sometimes they forget about internal communication and importance of having this dialogue also with the staff, branches, and the internal stakeholders, which is very, very important in these crisis times. And we can see also some medium-term mechanisms that may include the focusing on the new unemployed persons as a potential self-employed micro-entrepreneurs. And we know that for microfinance, especially former unemployed persons are the potential self-employed persons, which is one of the main segments for microfinance industry. Also increasing digitalization level to offer more competitive, flexible, and cost-efficient financial services to customers. Increasing diversification both with the target sectors and also to find some new industries to be financed, and also offering special conditions to clients who can, with proper support, increase exports in other countries, because now there is some opportunities to replace some businesses which is caused by the sanctions and logistical problems with Russia, Ukraine, and Belarus. So this was in brief from my side. Now to dive a bit deeper into a specific country context, I would like to invite Mr. David Rusier from the Banking Association of Georgia to talk more about the Georgian financial service providers' perspective. David, the floor is yours.
Thank you, Malhaz. Good afternoon to everyone. The Russian-Ukrainian military confrontation makes negative impact on the Georgia's trade relations. The results will depend on how long the conflict lasts, the impact of the war on involved countries, on regional leaders such as United States, European Union, or our neighbors such as Turkey, Iran, Kazakhstan, and so on. As you already know, Russia announced the leaving of World Trade Organization. And what will this impact of Russia's withdrawal from the WTO and whether this move will lead to the formation of large regional units or trade zones will probably be the subject of debate in the nearest future. The sanctions imposed on Russia Federation will have their effect over the year. Both Russia and Ukraine are the largest trading partners of Georgia. In 2021, import from Ukraine accounted for 4.5% of the total imports, which was reduced till 2.55% for the April of 2022. The opposite is the case of Russia, where the share has risen from 10% till 11 and 11.1%. In terms of both import and export, it should be noted that it would be very difficult for Georgia to even partially replace these markets, as they are historically established export and import market leaders, and Georgia doesn't have a market of equal strength in the immediate neighborhood in terms of raw materials. For the export, there was a permanent growth in the Ukrainian market, and in 2021 it reached $307 million. As for April, it has been reduced and reached only $55 million. Due to the blockade of Ukrainian seaports, entrepreneurs have to use Turkey-Romania-Poland road, which often increases the transportation time after 2 months. The Russian Federation also saw a decline in exports, which fell from 14% till 9.5%, facilitating the inclusion of large Russian banks on the sanctions list and making it difficult to make money transfer to Georgia and vice versa. When we talk about the sanctioned banks, it should be noted that most Georgian banks had correspondent relations with these large Russian banks. The VTB Bank of Georgia, one of the oldest Georgian banking institutions, has also affected by the sanctions, and its fate is still unclear. In the first 4 months of 2022, Russia ranked the third position of export market, while Ukraine dropped from 5th position till 9th position. As for tourism, the period of delay of people entering the country has partially changed. Only in March from Russia, we received 45,000 visitors, while in April it increased till 49,000 people. How many of them decided to stay in Georgia before the end of the war? Unfortunately, our Georgia Statistics Agency does not have such information. If we throw a glance to the visitors data from Russia, Ukraine, and Belarus, which are the core of the conflict region, we do not claim that this number of visitors will decrease. On the contrary, we may get an increase because due to the imposed sanctions, they may not be able to travel to Europe and America and will inevitably enter the markets of Turkey and Caucasus region. For the remittances from the Ukraine, they are declining naturally. It should be noted that the money supply from Russian Federation has increased sharply, and for the end of the 4th month of 2022, it equaled almost 24% of the total inflows. If in the previous period remittances from Russia equaled $26 million per month, only in April we received $132 million from Russia Federation. Of course, we do not expect cessation of cash inflows from these countries. In addition to the banking channels, the number of out-of-pocket currency has increased. The Georgian financial system is passing a rigorous test for the opening accounts for the foreign citizens and accepting transferred funds. The influx of somewhat counterfeit currency is also expected, but we are sure the Georgian banking system is ready to detect. I would like to say a few words about our banking sector also. It's difficult today to predict what will be the result of this year, but if we achieve a growth of 10% in assets, it will be a good indicator. When we are talking about 10%, it's our Georgian market was increasing during the last 3 years per 18% per year. So as for April, growth rate was only 3.6%. In April, the National Bank of Georgia did not take any steps to tighten monetary policy, and the refinancing rate remained at 11%. As for loan portfolio, it has stopped its growth, and as of April, it was increased only by 0.1%. The National Bank of Georgia's efforts have gained some results, and credit activity discontinued growth since the end of the year. By this decreasing the credit activity, National Bank of Georgia tries to somehow decrease the inflation rate, which is too high, while the announced inflation is only 3% and real inflation is about 12.8%. The steps taken by National Bank of Georgia to strengthen the larization process show results in every kind of stabilization of Georgian lari exchange rate. In April, the dollarization rate first fell below 50% psychological barrier and stood at 49 and 93%. It was for the loan portfolio. Despite this fact, in case of total, deposit portfolio, which are in foreign currencies, the rate increased. It was very strange for us also. It increased from 60.22% till 60.54%. Also, the population was not in a hurry to convert foreign currency into Georgian liras. Legal entities also stopped rolling, and free resources are converted into foreign currency. By the end of 2029, this situation could be changed by the low, could not be changed by the low interest rates offered by banks in foreign currency. Decreasing the GEL exchange rate is a driving element in the direction of increase or decrease of dollarization. We are expecting that National Bank of Georgia will make some new efforts to somehow decrease the credit portfolios, and they are trying now to somehow battle with inflation. These remittances and export and import increases, they are they are balancing each other, and all will be all results will be shown at the end of the autumn, when the summer season will finish, and when the part of the Russian and Ukrainian people, they return to their homes. Thank you.
Thank you very much, both gentlemen, Malchas and David. That was very insightful to see what's happening in Georgia as a neighboring country, and dealing with both with Russia and Ukraine. And good to see an active stance of your government and your central bank, and of course the banking association. to take the temperature and to deal with the matter. So good luck with the next steps on that. And now I would like to make a huge jump over to Uganda, because we have the possibility and the opportunity to listen to Violette Coubier as a program manager for the technical assistance at Grameen Foundation. She will give us some insights. What were her experiences in Uganda in dealing with refugee finance matters? So Violette, we are curious to learn how we can apply that insights in the current case here. The floor
Thank you very much, Michael, and good afternoon, everyone. So indeed, today I'm going to be presenting you a program we've developed with SIDA, the Swedish International Development Agency, the UNHCR, and 3 local FSPs in Uganda, namely BRAC, UGAFOD, and Vision Fund Uganda. The main objective of this program is to provide access to financial and non-financial services to refugees and host communities, 55,000 refugees and 51 host community members. And so to do so, we have developed a 3-tiered approach or a program with the first component that is debt funding from the Grameen Crédit Agricole Foundation to the MFIs for them to develop their loan portfolio by lending to refugees. The second component is a guarantee component with that is provided by SIDA to secure 50% of the loans provided by the foundation to these MFIs. And the third component will be technical assistance with a subcomponent that is going directly to the MFIs for them to strengthen their operations and adapt also their services to serve refugees. And a second subcomponent that is going directly to the refugees and the host communities through some grants to develop business and financial literacy trainings that are mainly delivered by local NGOs. So when we got started in the program 2 years ago, we found that FSPs were perceiving the following key constraints in engaging with refugees and delivering financial services to them. First, they were perceiving reputational risks because I think they were perceiving some societal fears, some prejudices towards refugees. And so this was reflected as well in public policies, in the media. I think the FSPs were also seeing some potential legal and regulatory barriers to lend to refugees and deliver services to them. And last of all, there was globally, I would say, a lack of refugee information and data from the FSP side that was really fueling also this perception of the refugees being risky high-risk clients. And so in reality, 2 years into the program now, we see that the key operational constraints have been, first of all, KYC issues, because most refugees in Uganda don't have a refugee ID card. So FSPs have had to find alternative ways to do KYC, and it's true that there are still important fraud risks. So it's very important for the FSPs to have very strong KYC processes. Also, we see a big constraint in the lack of tangible collateral from refugees, which clearly limits the maximum amount that FSPs can lend to refugees. And the last perceived risk from the FSP side also at the beginning of the program was what we will call the flight risk. So the risk of some refugees going back to their home country. And so it's true that we've seen that to some extent in the north of Uganda with some refugees going back to South Sudan. But this has remained really a marginal portion of the clients, and most of these clients are also still repaying their loans because they're going back and forth to South Sudan and Uganda. So overall, we will say that this flight risk has not really materialized. And so 2 years into the program, we are seeing the following results. The FSPs have opened 4 branches to serve refugees, so near the settlements. We have more than 8,000 active refugee borrowers with a loan portfolio equivalent to about 450,000 euros. And we have more than 31,000 people benefiting from non-financial services, so mostly trainings. And it's also important to mention that the repayment rate has been very good. So pre-COVID, it was excellent because it was 100% repayment rate. And post-COVID, it's still quite good, especially for the Uganda context, as we have a PAR 30 of about 4% in the branches of the program. So from our experience, the lessons so far we have learned 2 years into the program will be, first of all, that refugees have business ideas and that they show a strong entrepreneurial spirit. So there are here real opportunities for FSPs to provide financial services to them. We've also seen that many FSPs are lending through the village savings methodology, and this has proven really useful to boost savings, to enhance financial literacy. But what we also see on the field is that refugees do have needs for other services, such as individual loans, savings, transfer services, and so on. So here again, many opportunities for the FSPs to deliver such services. Another lesson we draw is that there is not specifically a need to create new financial services products for the refugees. Of course, in the Uganda context, it's very important to provide non-financial services, as I've said, and also, of course, to adapt current products, but developing new products for the refugees is, in our opinion, not a prerequisite. Also, we've seen from the field that having strategic partnerships, especially with local communities, is very important. And last of all, we've seen that employing refugees as a staff has been a key success factor for the FSPs involved in the program, because refugees speak the refugee language. They are better able to understand the cultural differences and also the refugee intentions. So employing them is really a key factor to determine credit risk. So I guess I'll stop here on the presentation of the program, and I would like to invite Nixon Kaheru, who is the Business Research and Development Manager at UGAFOD, and who will be able to speak a little bit more about UGAFOD's experience in the program and the perspectives. So Nixon, if you're here, the floor is yours.
Hello, everyone. So as a case study, we've been in partnership with Grameen Credit Agricole, and they've guided us under the grant from CEDA. And at this point, I'll only talk about the perceptions we had before we entered into the refugee finance space. The risks we envisioned, were more or less the same. Like Violet just talked about, something about refugee identification was a problem. The turnaround time to verify a refugee from the regulator, the Office of the Prime Minister. Again, they still didn't have collateral. That was the perception before we entered in. Stable incomes, since they were not really grounded to Uganda, they really didn't have a stable incomes where they would settle in and have sustainable businesses. And then the potential of high default due to the flight risk. So to manage these, we had to review our HR policies to hire refugee staff to serve them. And you see, refugees, as much as they're living together, they have different facts within them. They have factions within them, so they can't speak to each other easily. So it was an advantage to hire people from different factions, and so that they could understand each other. And then we also had to review the forms of identification to allow for attestation letters, to reduce on the turnaround time for verifications. We also acquired partners that would provide technical and business trainings to give them more sustainable approach to business, to their businesses. And we are still executing partnerships. Every sort of partner that has an influence on the behavior of the refugees is a very critical player in the space. Oh, thank you. I have 3 minutes. So we go. The lessons we've learned. They need financial literacy in order to be sustainable. They need digital channels are really critical. We need to invest in digital channels to reduce the cost of access, because we can't spread out through the brick and mortar business model. The policies, we need a review of the policies. Our regulators need to relax some of the restrictions, and regular interactions with stakeholders is also very key. That's why we said we keep taking up partnerships with all these stakeholders, everyone that has an influence on their behavior. And we are now looking to expand. For example, we are within one refugee camp, but it's very, very big. One office cannot sustain all of it. So we need to expand with more satellite offices around the refugee camp. So those are the lessons we've learned, and thank you so much for listening.
Thank you very much, Nixon, for your contribution. That's much appreciated. So I think we can move on. And
Yes.
give us a bit of perspective on BGR on Romania.
Thank you very much. Thank you, Michael, and thank you for having me here. I would like to introduce you to BCR Social Finance, which is part of the BCR. BCR stands for, in Romanian, for the Romanian Commercial Bank, which is one of the largest banks in Romania, and Erste Group in Europe. And BCR Social Finance is a non-banking financial institution with a mission to create social impact through dedicated financial products and business education. As a group, we have been active in setting up support system for Ukrainian refugees in the first two refugee stages. In particular, the group, and especially the BCR, the bank, set up a comprehensive program that includes permanently adopted measures to provide refugees with financial and non-financial services. And this includes offering initial basic financial services, as well as providing essential humanitarian support through direct donations and key partnerships with trusted NGOs. If we go to the next slide, I can tell you that specifically the bank was present at the border with mobile branches, fully equipped, so that the refugees can have immediate access to banking services, opening special accounts with zero cost for the bank and with zero cost for cash withdrawals throughout the country. And it made also immediately available the currency exchange from hryvnias to the local currency at the best rate, the rate offered by the National Bank of Romania. It also facilitated donations to support Ukrainian children and youth directly, and also to the online banking application. Participated in the development of the Jobs for Ukraine platform. If you're not aware of what this is, it's an app, a platform that enrolls companies and job seekers. And it's more than that. Actually, the platform can be accessed from all over the world, and with employers not only from Europe, but also you can name it. We have also offers from the United States. The platform ensures also relevant information regarding labor regulation for refugees and housing information, and it is available in Ukrainian. Another intervention was to develop dedicated support systems for Ukrainian citizens, such as dedicated phone lines and email inboxes available in Ukrainian to ensure easy access and information for the refugees. And this is a very concentrated report on our intervention for now. We hope to do more for the future. Thank you.
Laura, thank you very much for drawing this up. I was really excited to hear about the NFS non-financial services with the Jobs for Ukrainian program. That sounds like BGR is going beyond ordinary financial services to this very vulnerable group. That's great to hear. And with that, we move on. It's time for another poll. We're always interested to measure the temperature with our audience. What is your mood on the question, how has your institution considered implementing fintech solutions? And so you have 5 options to answer. If you would please answer them and we can have a look at this. Of course, the topic of fintech is not limited to refugees, but as it appears, it can be connected. As again, the example we just saw here about the jobs program is also a digital tool that helps refugees to cope with a very important challenge. So we are much looking forward to see what is the mood here on fintech, which has been a topic now for quite a while. So I hope to see many in the top layers, but I won't influence you. So let me see, we can pull up the result here. Yes, we are interested in fintech solution is a leading answer, and then we are currently implementing, and we are interested in, okay, so quite active, proactive, and little said in the last two slots here. So quite active sentiment. That's probably nothing to really comment on what was expected, more or less, good confirmation. And with that, we come almost to the end. We have a little bit of short of time, but Dimitro promised me to be concise and shorten it a little bit. So Dimitro, you will speak about fintech solutions. And as someone who knows not only the Ukrainian market, but the Ukrainian market as well, I think you are well positioned to talk about this topic. So we're looking forward to hear your thoughts about how fintech can help improve access to finance. Dimitro.
Thank you, Michael, and everybody here. So from lending point of view, it's quite reasonable to finance any person who is willing to gain or already has a stable income as a salaried person or an entrepreneur, in order to improve the likelihood of successful integration. But most formal financial institutions, refugee financing is seen as just too risky. There are too many barriers, such as Violet said, legal barriers, reputational risk, lack of information. So very few traditional banks offer credit or loan facilities to refugees, despite evidence that refugees repay financial assistance as quickly and completely as the average global borrower. Alternative lending tools can help refugees get over the hurdles around KYC requirements and the lack of credit history or collateral. So what are the solutions that could fill the gap? Let's explore them in more detail. There is no doubt that neither traditional banks nor fintechs could deal with financing refugees without lending arms and the support of governments or donors. We will mention here just some examples of refugee financing. As Violet mentioned, there was a Vision Fund that was able to pilot some products specifically designed for refugees in Uganda and in Peru. In Peru, it was a project that allowed Venezuelan medical professionals like doctors, nurses, dentists obtain financial support to afford validation for their qualifications to enter the professional labor market in the country. Refugees resettled in Canada must pay for their medical exams and their travel to Canada. Since most refugees, of course, cannot afford these expenses, Canada offers them a loan. As a result, refugee families start their new life in Canada with a debt which they must repay with an interest. In Australia, FSPs also provide business loans to skilled immigrants and refugees so that they can obtain licensing or training required to work in their field or to secure a position which matches their level of education, skills, and experience. And my box in Malawi case, it was the first financial institution to provide a full range of services to refugees in camp. The bank saw the business potential of this untapped market, and actually they tried and received a waiver from the central bank to use refugee forms to allow refugees to open bank accounts, tackling KYC barrier. There are many other examples that are not mentioned here how refugees could be financed. But let's also look at an alternative approach, for example, developed by Tala company, for those who do not have a credit history or even an address. Although not specifically designed for refugees, it could be certainly be used as a good example. They collect thousands of data points from a single smartphone. As it turns out, how someone uses their phone provides many insights into their capacity to repay a loan. For example, the data shows a 4% increase in repayment among people who consistently communicate with a few close contacts, and a 6% increase among those who are consistent with where they spend most of their time. They also found that individuals that communicates with 58 contacts or more and makes phone calls that last for more than 4 minutes, they actually indicate strong social networks, meaning they are more likely to repay a loan. If more than 40% of a person's contacts are listed by both first and last name on their phone, they are 16 times more likely to repay a loan than someone who does not do this. Tala software crunches together these and thousands of other variables to establish financial identity of a refugee. How it works? After someone downloads the Tala application and requests a loan, it asks for permission to view the key pieces of data on their smartphone. The data includes texts and calls, merchant transactions, app usage, and personal identifiers. After assessing all this information, which takes just a few minutes, Tala decides whether a customer is creditworthy, and if so, immediately sends the money via a mobile wallet. This tool is used in developing countries by more than 6 million people and has high repayment rate of over 90%. As we can see, user phone data could serve as a rich source of factors for alternative credit scoring. But mobile phone is not the only rich source of data. Many other financial, social, and business data points could serve as alternative credit scoring. One of the companies which I mentioned here that is a data aggregator is HubSpot, which has access to Ukrainian credit bureaus and state registers that could actually be used and implemented into alternative scoring system. So, in summary, refugees have a strong need for comprehensive financial services, including lending. The refugee subsequent is an opportunity for FSPs. Private-public partnerships are an important part of many refugee and IDP programs. Fintechs are naturally better positioned to provide refugees with financial services. And we should think about usage of alternative sources of data for credit scoring because they are quite feasible in refugee financing. Okay, that's all. Thank you for your time and participation.
Dmitro, thank you very much. And I think your example was very illustrative to demonstrate that innovation in terms of fintech can be particularly helpful for marginal groups like refugees. They just don't bring the other data. So there's even maybe not much alternative than taking those data compared to someone like a typical microclient who is working in his location, and there are a lot more data points to be collected. I found that a very interesting. All of you are invited to participate in another survey. Actually, 2 questions here at the end, where we have a question on the support of financial needs for migrants. So what you think is most needed, and also on your plans, what you plan to do in your institution in this regard, which will give us at the end of the second webinar some ideas of what else might be needed. And I think information our dear sponsors, Triple Jump and Microfinance Center, are very interested in. So looking forward to your answers in these 2 poll questions. And while this is being answered, I can already make an announcement. So I'm glad to inform you all, many of you might know already, that we are nearing the 24th annual microfinance conference, MFC conference, which will be held in Istanbul in Turkey, June 29 and 30th. So I think you will also get a link, and you see it here on the slide already. Of course, it's a great opportunity always, I can say from my own experience, to join the MFC conference, not just to meet with many colleagues and interesting people, but also hear a lot of good new information about many topics. And as you can see, the topic is not too different from what we were discussing in the last two webinars. We speak about microfinance investing through uncertainty. So we hope to see many of you on that conference, and in a bit more than 1 month from now. Good. And yeah, we see the results here. 53% technical assistance to adapting existing new methods would be interesting. Okay, as a consultant, I'm happy to hear that. And I think MFC and Triple Jump are also happy to hear that. There's demand for such services for specialists, and our panelists will be happy to hear that. Grant subsidies for non-financial services, we'll pass that on to people who have the grants and subsidies. Guarantees, same here. Borrowing for on-lending, also needed. So the whole package basically is needed to meet these new needs. And 29% are already having that in their strategy to help refugees. Great, super. And 35 are considering this possibility. Okay, that's 2-3 months after things unfolded, still explainable. And another third is basically not considering the possibility. And that also gives us a good indication that it's not seen as something very hot everywhere, which is understandable. And it's my great pleasure to close this webinar, the second webinar on refugee finance in times of uncertainty. I think we discussed a very important topic. I'd like to thank very much again our panelists, the special guests, and you, dear audience, that you were here, and wishing to all of us to continue the important work on supporting refugees, and not only these refugees, but any refugees that might come. And hopefully we have many learnings from the current situation to become better and better in supporting people in need. It was a great pleasure to see you all here, and I hope to see many of you in Istanbul end of June, and say bye-bye for now. Take care and good luck with your good work. Bye-bye.